welcome to NDTV Profit. I'm Tamanna Inamdar and you're watching The Talking Point. Today we're talking about why markets are nervous. Now, for the last several days, you've seen Indian markets in a range-bound trade. Now, ordinarily, that wouldn't be too surprising, but considering two factors, one wonders why the markets are panicking. The India VIX has been on a climb and that's showing a bearish trend. Now, the reason why I say this is surprising is because, for one, global cues have turned very clearly positive. Jobs data that came in the US for the month of April is showing a slowdown in new jobs created. That kind of a commentary is pointing to the possibility of a Fed rate cut this year. In fact, the outlook and polls for 2 Fed rate cuts this year has increased to 66%. Now, whether that happens or not remains to be seen. So the global Q setup is looking more positive than it was, say, even a month ago. On the other hand, we are in the middle of another major factor or event, I should say, which is the Indian elections. We're in phase 3. But once again, that is something that the market has priced in for a while. So what is the fly in the ointment, if any? Is it maybe rich valuations? Is it corporate results? What is bothering the markets? To speak on this, I'm joined today by Andrew Holland, the CEO of Avendus Capital, Public Markets and Alternate Strategies. Andrew, welcome. Always a pleasure to speak with you on NDTV Profit, and great to have you back here again.
Thank you, Tamanna. It's always a great opportunity for me, so thank you.
All right. So let me start with you setting the context, and I talked a bit about it in my opening comments. And that really is the big question right now, isn't it, Andrew? What really is making investors a little wary? You're seeing that in fund flows. You're seeing that in the kind of bets that are being made. And is it more a question about waiting for June 4th and having that box ticked before bringing in any fresh money?
So there's a few things. It's all very good points you've made, and I think you're right in the terms of the tick box. You know, some of the voter turnout's been a bit lower than maybe was expected because of obviously the weather is so hot. And of course, you know, both sides of the market's juggling around, is that good or bad for the opposition or the incumbent parties? So I think that's what's making the market a little nervous at this point. And I think the second point is, you know, China has actually seen some recovery in terms of sentiment. And you're seeing a lot more of the brokers now becoming, you know, more positive on China. And I think that's taking some of the flows, you know, to China, possibly from India, in terms of, you know, the very short term. So I think that's a factor. And of course, you know, the market compared to ours is a lot more, you know, in terms of valuations, a lot more cheaper. So I think people don't want to miss the China rise if it's going to happen. And India's had a great run, and we had the election. So sit on your hands, wait to see what happens, tick the box afterwards. I think the final factor has been the earnings season. And the two factors that we were looking at for the earnings season was, would IT and would banking kind of finally show that the kind of worst is behind us? And if that was the case, then obviously that would be a catalyst for the markets to move higher. IT, yeah, I think the jury's still out. I don't think it's reached bottom yet, and with interest rates likely in the US to be later in the year in terms of cuts, there's no tailwind. For the banking sector, though, I think that you know, the NIMs have seemed to have normalized, and that's why we're seeing the banking sector outperform. But the final factor, which is kind of spooking the market in the short term, is some of the regulatory, you know, kind of changes that the RBI is making. You know, whether it's for single banks or whether it's for you know, loans for you know, construction going forward. So that's the regulatory part which the market's not liking at the moment.
I just want to come to, you know, some of these points in greater detail, Andrew, because each of them deserves a bit of expansion. Let me start with the China factor. Now, how real is this China factor? We've been hearing about it for months, but the data is not there yet, right, to support the hypothesis of a Chinese economy revival? Or do you think there is enough there and you're seeing the green shoots?
Well, there's certainly if you go to the US, for example, all the data points that we get are so mixed that we keep flip-flopping around on interest rates being, earlier or later in the year. So I think with China, where it's even more difficult to get data, I think the market's saying that we've reached a bottom. The authorities there have kind of put with the banking sector, have kind of stabilized the property market. Now, you still need confidence to come back, but the fear is that the market is so cheap for investors that, if you miss the kind of first rise of the markets, then you're going to be chasing the markets for some time. So I think that's the fear factor of missing out on a China re-rating. So I think it has stabilized. I think the data I've seen has been more stable. Obviously, inflation or disinflation there is still taking hold. So they do have the ability to reduce rates over the next quarter, and I wouldn't be surprised if that currency continues to depreciate against the US dollar again, which would help exports going forward. So I think that's the China story as such, and I think it's probably to the point where valuations are cheap enough to dip your toes is what we've been seeing by foreign investors.
So maybe the economic data doesn't, still really underline that optimism, but valuations are cheap enough to dip their toes. So then now let me take that question forward. What about valuations in the Indian market? Is that why we're also seeing some of those concerns or that wariness, Andrew? Because valuations have run up, and then the question is that the numbers we've seen, the corporate results we've seen for FY24 as well as Q4, have they lived up to justify those valuations?
I think by and large, the overall results season has been kind of in line. I don't think there's been massive excitement in any particular sector. I think the banking sector is probably the standout for me. But I think overall, from what I've seen, earnings are up about 14%, and that's in line with our kind of 10 to 15% earnings growth for the year. So there's no big upgrades that you've seen in the past, and I don't think we'll see those upgrades till the back end of the year, as a multiplier effect of all the government spending, which will happen over the next 6 months after the elections, will start to feed through to the economy. So I think those are the factors which will increase earnings. But at the moment, there's no real catalyst in the market to push the earnings growth higher at this point, which would mean that valuations come down. So I think we're kind of in that neutral zone ahead of the elections. I don't think there's anything that's going to push the market. I thought the banking sector would, because it's such a huge weightage, and if anything, it's held the market up rather than probably would have seen it kind of go down. So I think people have been taking money off the table a little bit just to be wary. But there's a lot of money still in the sidelines that want to come into the market. I think everyone's just waiting for the elections, as you said, to tick the box and say we can move forward.
Just wanted to understand, Andrew, do you think that this tax treaty or tax revision rules in Mauritius, which came in a few weeks ago, is still weighing heavy on FIIs? The fact is that nothing can be done about it because there's an election on right now. Any decision one way or the other, or any movement happens post June 4th. Is that still a problem?
I'm not from what I'm picking up. It's been there for some time, and a lot of funds had moved to either other jurisdictions. Obviously, Gift City is something that India will push as a jurisdiction going forward for foreign investors. I think just on the tax side, though, Tamanna, I think the thing that we're picking up time and again is that there could be some, after the elections, there could be some tax tweaks, particularly to capital gains tax, probably on arbitrage fund tax going forward. So that will, I think that's probably what the market's kind of getting a little bit worried about is maybe not on the elections ticking the box, but what happens in the next budget, and will there be any changes in the capital gains tax? Because you can't fund all of your expansion just through equity. It's got to be debt as well. So let's see if there's any normalization towards those tax rates, which are very, very far apart at the moment.
Just one point on the elections, and you talked about how you are unlikely, or you think it's unlikely to show any big movement. Markets are unlikely to show any big movement before June 4th. And I was wondering why, because for the last several months, especially since the December assembly elections last year in 5 states, the markets seem to have priced in policy continuity. Why the trepidation now?
I think it's just that the market had such a good run in that November, December coming into the year that it probably took that kind of pre-market or pre-election rally into the back end of 23, and therefore, what are the catalysts? If we're all saying that it's a policy continuation, then we'd have to wait and see what those policies would be, along with what would the budget be. And I think that's what the market's just a little bit nervous on those possible tax changes in capital gains tax.
Andrew, I just want to talk about the FMCG play. So earlier this week, you saw on Monday, you saw Britannia respond, I would say a bit surprisingly, to the numbers. Numbers were good, but were they that good? ITC, HUL, Marico, Godrej Consumer. It seems as if now perhaps the market hunting for new pockets is rediscovering FMCG. Is that the way you're looking at it? Were you surprised?
See, Tamanna, it's been a very unloved sector, right, for the past year or so. I mean, the two negatives have been there's been no volume growth, rural spending is too slow, or it's kind of underwhelming. And of course, companies have come back and surprised on two fronts. One, margin was a bit better than the market was for baking in, and second, the rural economy is starting to pick up. So those two factors. So where would you go for safety if you want safety in the market in terms of the volatility that we're seeing, Tamanna? Then do you go to IT, which is still struggling to get through to the bottom of the kind of earnings cycle, or do you now go to a FMCG where you have three factors: margins are good, rural economy is picking up, it gives you the volume growth, and premiumization, which we talked about a number of times in the past. Those are the three factors which you say, okay, if I want defensive, let me go now for consumer, which has been unloved, and it's probably underweighted by most funds, and that's probably why you're seeing the share prices rise so quickly, because there's been no real buying. Everyone's just forgotten about the sector. It's a bit like the pharma sector. Everyone's forgotten about the pharma sector.
So unloved. If FMCG was unloved till now, it's changing. But the primary issue, or the primary problem, is that showing enough signs of being fixed, Andrew? That really is my concern. At the end of the day, the issue always was rural consumption, not growing as much. Not all of these companies are, moving towards complete premiumization. If you're looking for that play, maybe you'd look at QSR or, specific pockets. But I'm talking about the big majors, your ITCs, your HULs, your Britannias, your Nestle's. Is anything really changing there, or the market now betting on the fact that post-election there will be a lot of push for rural spending, and maybe that will play out?
I mean, that's what the market's now getting more excited about, is with the commentary from these FMCG companies that, the rural economy is going to start picking up in the second half of the year, of the calendar year. And therefore, that's where you get the volumes and obviously the margin improvements. I think if you want to play premiumization, I would probably go for the beverages sector rather than the just pure FMCG sector. As I said, it's just been unloved, and I think you're just bouncing from the bottom of an unloved sector. I don't think I'm a buyer into this whole kind of rural economy spending and these companies doing better. I think there are some kind of special companies in terms of corporate action that's happening. I mean, obviously ITC will be divesting of its hotels at some point, and then if I look at Hindustan Unilever overseas is obviously under some kind of pressure to do something with the businesses from activist shareholders. So we could see a little bit more action within the sector. But those would be the only catalysts I could see. I think it's a bit early to say that the rural spending is going to pick up and they're going to see this double-digit growth, which everyone's now kind of backing. 2 weeks ago, no one would tell you that.
Yeah. The other, I think, big factor which hasn't been discussed enough, if I'm being honest, Andrew, is regulatory action. It has, in a sense, become the single largest headwind to companies in the BFSI space, whether it's SEBI, whether it's RBI, whether it's problem with IT, or draft regulations talking about higher provisioning. Has that made you a little wary of this entire space?
Yes, it does. I mean, I can see the reasons behind it, and obviously, it's good for the longer term kind of health of the sector, because you don't want kind of unsecured loans kind of ballooning and then some problem in the economy. That's what the RBI wants to kind of fight against, given past experiences. So I don't think it's a bad move in the longer term, but short term it just gives that uncertainty of what's next. Could there be something else that's going to come out? So the banking sector or the financial sector was just starting to outperform, right? And then you had this extra regulation come in, which has dampened the sentiment. And of course, now we wait for, who's next or who could be next. And that uncertainty doesn't help. Markets don't like uncertainty. And therefore, that's why you've probably seen the volatility, not just within the sector, but within the market increase as well. So I think that's one of the factors which is keeping our markets down, rather than we should have had. I think the banking sector should have had a bigger rally than we've seen so far.
So now let's come to specifics, Andrew. Viewers who are watching this obviously are very interested in your views, but I would also like to get your insights into what are the sectors that you see as possibilities of growth over the next, medium to long term, I would say, or at least over the next few months. Would you be waiting till post-elections to really make some of those investments? And what are the spaces that you find interesting?
So, Tamanna, the sectors that, I don't think you have to wait for the elections, because there's certain sectors where there's going to be government spending. Defense is one, railways is the other, infrastructure is the other. So those three, kind of segments, I would, you're just going to see a lot of growth going forward. So whether you have the election, whatever the results are, those three are going to see continued spending, as you would globally anyway. And renewable energy is one of them as well. I think in terms of themes, there's two themes that I think are still very nascent. That's the premiumization of beverages, both alcoholic and non-alcoholic, and I think that's going to continue as people, spending power, per capita GDP at $2,500. It's just going to continue rising. So at the very start of the runway there. And I think the same in the electronics manufacturing sector. I think, it's early days, a lot of new players coming in into this sector, and I think it's going to be there's enough size there, both domestically and for exports going forward, that you'll see some of the big leaders come through over the next 3 to 5 years.
Just in terms of defense and railways, now, I would say the only question mark there, Andrew, is that look at the run up already in some of these. If I even pick up a Titagarh Railways, that entire, Paris Defense, that entire lot has already run up. And then do you look at the state-run companies as the first choice?
Well, I mean, a lot of them are state-run companies, so you don't have the choice anyway. The way I think about it, Tamanna, is this: is I fast forward 3 years and say, what would be the profitability of this company in my view in 3 years' time, and what's the PE then? Because if you look back, you're probably buying something which you think is expensive now, but actually was cheap because of the growth that you'll see in both earnings and revenues over the next 3 years. So fast forward, look at the valuations, work it back, and say, is it still looking cheap? So that kind of growth in the industry you can't capture, in the kind of just the forecast over next quarter or the next 2 quarters. You've got to have a longer term view of where you think that company is going to be.
Another space that I wanted your view on, Andrew, is reality. And when you go through their corporate numbers, which have come in this year, and I was having this conversation actually with the management of one of the companies, And I asked, your profits have come down, your margins are a little squeezed, are you worried? And he said, we don't look at all of this in our space. We look at pre-sales. And yes, pre-sales look good, but I just wanted to get your sense on this. What are you looking at when you're looking at some of these real estate companies? Are the pre-sales or the future potential now already priced in, or do you see a further upside there?
Obviously there's different real estate companies in different parts of the country as well, so you have to look at them equally in a different light. I've never looked at pre-sales, to be honest, because it lends itself to something like, let's just say you're building something and then, a lot of investors come in, they buy at whatever price they buy at, only to sell later on to make the profit. So someone's making more profits than the real estate company, that's for sure. But once that market dries up for whatever reason, then obviously that those kind of pre-sales don't become sales, so therefore your ratings would fall. So I would never look at it. I would look at only two things: land bank, cost of land bank, and how quickly can they deliver those the buildings or apartments or commercial real estate. That's what I'd look at. And I'd obviously look at real estate companies which have got that commercial rental base as well, because that will help them through any difficult time that they have. I think one sector which has kind of been ignored for a little while now is affordable housing. And I still think that's going to continue to grow. Maybe not at the kind of heady rates that we're seeing in some of the more premium markets of real estate. And that's what captures the headlines. But don't forget, when you do affordable housing, it's these people that move up in terms of aspirations going forward. And that's the key. If you don't have that, then the market doesn't move from the lower end all the way through to the top end.
Absolutely. So I think it should be a little more judicious when you're looking at that pack as well. Thank you so much, Andrew. Always a pleasure to have you on, and hope to see you.
Thank you
back
again.
soon. Andrew Holland there on why markets have this kind of, I would say, careful outlook right now, and you're seeing that range-bound trade continue. But that's all the time we have for this edition of Talking Points. Stay tuned. A lot more coming up on the other side on NDTV Profit.